Welcome back to Smart Stock Sam, the channel that turns Wall Street noise into a clear, actionable signal. Today we're diving deep into why POET stock could explode next week, breaking down the June catalysts that have this thing positioned as one of the most explosive setups on the market. We're going to walk through the wild ride that got POET here, the institutional money quietly building positions, the short sellers who may be sitting on a ticking time bomb, and a legal deadline just days away that could force one side of this trade to fold completely. By the end of this video, I'll hand you a complete level-by-level trade blueprint for the week ahead. But stick around, because there's one number buried deep in the options and dark pool data that could change everything you think you know about this setup. Before we get into where this stock might be going, let's talk about how we got here, because the last 7 days have been nothing short of remarkable. If you caught our video from June 14th, you'll remember we laid out a precise setup for POET. We called for a breakout trigger at $13.01, a primary target of $14.50, and a hard stop loss at $11 even. And what happened next is exactly the kind of move that makes this stock so fascinating to trade. The very next session, POET gapped up to open at $13.15, instantly triggering the setup, then surged all the way to an intraday high of $15.08, blowing right past our target, when the stock cooled off later in the week and dipped to a low of $11.59. That $11 stop loss held firm, shaking out the weak hands while protecting capital, before the stock settled into a close around $12.15 on nearly 20 million shares of volume. It played out almost exactly as mapped. Of course, past setups don't guarantee future ones, and every trade carries risk, but it's a useful reminder of how sharply this stock can move when momentum builds. So, with that backdrop, what does the picture look like heading into the new week? For the week of June 22nd through the 26th, we need a fresh read on this stock because the landscape has already shifted. POET fits the profile of what traders call a high beta asset, meaning it tends to move with far more intensity than the broader market in both directions. The driving force behind the recent action isn't generic tech optimism, it's surging demand tied to AI infrastructure build-out, the same theme that's been rewarding semiconductor and photonics names across the board this year. Based on current volume patterns, the stock appears to be in what looks like an accumulation phase, where larger buyers may be building positions quietly, in smaller increments, ahead of upcoming news rather than chasing the price in one obvious sweep. That kind of patient buying behavior is exactly what you'd expect to see if someone believed a catalyst was coming. So, could this quiet positioning be setting the stage for a much louder move next week? Let's dig into the numbers and find out, starting with how we even got to this point in the first place. To really understand why this stock has so much pent-up energy right now, we have to rewind and look at the chaos of the last 2 months. Back in April, POET took a brutal hit, falling 47% down to $7.95. The trigger was Marvell Semiconductor pulling all purchase orders tied to its Celestial AI unit, after POET's CFO reportedly discussed confidential order details during a public podcast appearance, an alleged breach of a non-disclosure agreement. It was a messy, self-inflicted setback, but then came May, and the rebound was just as dramatic as the fall. The stock rocketed over 213% year over year to a high of $20.81. What changed? POET appeared to offset that lost Marvell business with a new $50 million initial supply order from Lumilens, one with a framework that could scale up to $500 million over time. But here's the detail that really reframes the entire story. POET closed a $400 million registered direct offering, and the entire amount was absorbed by a single institutional investor who paid roughly $21 a share, a steep premium over today's price, specifically to help POET scale its 2027 manufacturing capacity tenfold. Now, when one institution writes a $400 million check at a premium like that, it forces you to ask a different question. What does that investor see that the broader market hasn't priced in yet? That question is exactly what's fueling the tug-of-war between bulls and bears on this stock right now. On the bear side, the case centers on what we'd call administrative friction. Short sellers, including firms like Wolfpack Research, have zeroed in on the Marvel contract cancellation, the resulting lawsuits tied to the alleged NDA breach, and Poet's classification as a passive foreign investment company, or PFIC, for tax purposes. That PFIC label matters because it currently restricts certain U.S. institutional funds from holding the stock at all. That's the bear thesis, and it's a real one. But the bull case is built on something different entirely: structural strength. You've got that $400 million capital injection at a premium valuation, a $50 million Lumilens order with room to scale tenfold, and serious institutional capital validating the underlying AI photonics technology itself. So which side wins this argument? The next 2 weeks may tell us. And it's not just company-specific news that's working in the bull's favor. The macro backdrop is shifting too. Recent geopolitical developments, including easing tensions tied to the U.S. and Iran, have helped cool global oil prices. When commodities ease up, it tends to ripple through the broader economy, calming inflation expectations and pulling treasury yields lower. And when yields fall, capital often rotates out of safe haven bonds and into risk-on, high-beta sectors, including AI infrastructure names like POET. Historically, this is the kind of macro backdrop that has rewarded smaller, high-volatility growth names precisely because investors feel more comfortable reaching for risk when the cost of safety starts to drop. It's the kind of environment that has historically rewarded stocks exactly like this one, though of course, macro conditions can reverse just as quickly as they appear. So, is the macro stage now set for a move higher, or could a sudden shift in sentiment undo all of it overnight? Let's look at what the professionals are actually saying. When we dig into analyst sentiment and institutional positioning, the consensus is more unified than you might expect. The average Wall Street price target for Poet sits at $20.25, which implies roughly 66% upside from current levels, and the highest targets on the street reach as far as $23. On a fundamental basis, the stock trades at a price-to-book ratio of 4.14, which is actually below the broader semiconductor industry average of 6.2, suggesting it isn't stretched on that particular metric. But the real story may be ownership. Total institutional ownership sits at an elevated 48.13%, with major holders including Citadel and Morgan Stanley. Meanwhile, insider ownership is razor-thin at just 0.23%. Pair that level of institutional conviction with a retail sentiment gauge currently reading extremely bullish, and you have the ingredients for a potentially volatile week. But ingredients alone don't guarantee a result, so let's check whether the chart actually supports it. Technically, POET is showing what looks like a classic shakeout and base pattern. Despite the wild swings of the past 2 months, the broader uptrend remains intact, with price holding comfortably above the 50-day, 100-day, and 200-day moving averages. The near-term hurdle is the 20-day moving average, currently acting as resistance around $13.02. What stands out, though, is how much room the stock has to run before hitting overbought territory. The relative strength index sits at a neutral 48.97, and the MACD is only mildly negative at 0.11. In plain terms, the stock has fully reset. There's meaningful room for a sharp move higher without immediately running into resistance from overheated momentum indicators, but charts only tell part of the story. The real fuel may be sitting somewhere else entirely. This is where things get genuinely interesting, because the mechanics underneath this stock resemble a coiled spring. Roughly 23.2 million shares are currently sold short, representing 13.47% of the tradable float. But the number that matters most here is the days to cover ratio, sitting at just 0.86. In simple terms, if average trading volume shows up, it would take short sellers less than a single full trading day to buy back every share they've borrowed. If volume spikes on positive news, those same short sellers could find themselves with very few good options. And notably, nearly 47.4% of all short volume is being routed through dark pools, off the public exchanges, which makes it harder to see real-time positioning. So if the shorts are this exposed, what happens if buying pressure actually shows up? The options market may already be answering that question. The options chain is flashing some genuinely eye-catching activity. Trading volume recently surged to almost 249,000 contracts, and 87% of that volume came from call options, a heavily bullish lean. Open interest now sits at 1.65 million contracts, which is 108% above the 30-day average. But the detail worth sitting with is this. A large block of 4,000 call contracts at the $17 strike price, expiring in July, was purchased in a single transaction, with roughly $600,000 in premium paid. That's not the kind of trade a casual retail account typically places. It has the footprint of a much larger, more deliberate bet. That kind of concentrated positioning suggests someone is making a sizable wager on a significant move higher, and the timing, lining up neatly with the late June catalysts, only adds to the intrigue. If the stock starts climbing toward that strike, market makers hedging those calls may need to buy shares to stay balanced, which could add even more upward pressure on top of any short covering already underway. Could that combination create a magnetic pull toward the $17 level? It's a real possibility worth watching closely, though options flow alone has never been a guarantee of where a stock ends up. So what could actually light the fuse here? It may come down to two very specific dates next week. Mark June 26th on your calendar. That's the date of the annual shareholder vote on redomiciling the company to Delaware. If shareholders approve it, it could resolve the PFIC tax classification issue we mentioned earlier, potentially opening the door for U.S. institutional funds that have been sidelined to step back in. Then, just 3 days later, on June 29th, the lead plaintiff deadline arrives for the pending class action lawsuits. Once that deadline passes, the steady drumbeat of law firm press releases that often accompanies these cases tends to fade, which could ease some of the algorithmic selling pressure tied to negative headlines. Now, here's an important note. Shareholder votes don't always pass, and legal deadlines don't automatically resolve favorably, so these are catalysts to watch, not guarantees. But if trading volume does climb meaningfully above the 40 million share daily average around these dates, that razor-thin 0.86 days to cover ratio means even a modest surge in buying could force short sellers into uncomfortable decisions. Before we map out specific price levels, it's worth pausing to ask yourself what kind of investor you actually are here, because that changes how you should be looking at this stock. If you're approaching POET as a short-term trade over the next 1 to 4 weeks, your focus should be squarely on how the stock behaves around those June 26th and June 29th dates. Watch the tape for volume surging past 40 million shares, and treat the short interest setup as a possibility to monitor, not a certainty to bet the farm on. If instead you're thinking about POET as a longer-term position into 2027, your homework looks completely different. You'll want to track how well management actually executes on that $50 million Lumilence framework, whether that $400 million capital raise translates into real manufacturing capacity at the promised tenfold scale, and whether the company can meaningfully narrow its cash burn as it shifts from research and development into actual product revenue. For traders specifically eyeing the short-term setup, it helps to understand exactly how a move like this could theoretically unfold, step by step. Think of it as a kind of squeeze engine. Step 1 is the catalyst itself, the company clearing the June 26th and 29th dates without major setbacks. Step 2 is risk removal, where administrative uncertainty fades, previously restricted institutional capital becomes eligible to buy in, and algorithmic selling pressure tied to legal headlines tapers off. Step 3 is short covering, where any fresh institutional buying pushes the price higher, putting pressure on that 13% short interest. Because those shorts have less than a single day of average volume to work with, Even a modest rally could force some of them to buy back shares simply to manage risk. Step 4 is what some traders call gamma ignition, where that forced buying pushes the price toward the $17 zone where the large call position sits, potentially prompting market makers to buy shares to stay hedged. Now, to be clear, this is a sequence of conditions that would need to fall into place, not a guaranteed outcome, and any one of these steps could fail to materialize. But understanding the mechanics helps you see exactly what the bulls are watching for. So, with all of that mapped out, what does an actual trade plan look like for the week ahead? Here's how we're approaching it. The accumulation and entry zone sits between $12 and $12.30, close to the 10-day moving average. There's recent support near $11.50, but the hard stop loss for this setup is $11 even, your line of defense if the shareholder vote fails or the broader market turns lower. The breakout trigger to watch is a clean move through the 200-day exponential moving average, somewhere in the $13.23 to $13.50 range. If that breaks, the first target sits between $14.50 and $15.08, a logical spot to take partial profits and protect your capital. From there, a smaller remaining position could be left to run toward a secondary target between $17 and $17.50, the zone tied to that large call position, though reaching it depends on several of the conditions we just walked through actually playing out. So when you step back and weigh everything we've covered, what's the actual takeaway here? POET's current weaknesses, the tax classification and the pending lawsuits, appear largely administrative and potentially temporary in nature. Its current strengths, a substantial capital position, a scalable Lumilens partnership, and a short interest setup that looks structurally exposed, are more fundamental to the business itself. If the company successfully clears those administrative hurdles around June 26th and 29th, there's a reasonable case that the underlying strengths reassert themselves in the price. But markets are unpredictable, catalysts can disappoint, and squeezes don't happen just because the setup looks good on paper. So treat this as one possible scenario among several, not a sure thing. Now, before you go trade any of this, I want to be upfront with you. This video is for informational and educational purposes only and should not be considered personalized financial, investment, or trading advice. I am not a licensed financial advisor, and nothing in this video is a recommendation to buy or sell any security. Stocks like POET, with high short interest and heavy options activity, carry significant volatility and risk, and you could lose some or all of your investment. Always do your own research. Consider your own risk tolerance and financial situation, and consult with a licensed financial advisor before making any investment decisions. If this breakdown helped you see POET a little more clearly, here's what I'd love from you. Drop a comment below and tell me this. If POET clears both the June 26th vote and the June 29th legal deadline cleanly, do you think the short squeeze scenario actually plays out, or does the broader market pull it back down regardless? I genuinely want to hear your take. While you're down there, hit that like button. It helps this channel reach more traders who need setups like this one. And if you're not already subscribed, go ahead and join the Smart Stock Sam community so you don't miss next week's follow-up. If this video gave you real value and you want to support the work that goes into these breakdowns, consider sending a super thanks using YouTube's built-in support feature. Every bit genuinely helps keep this channel going. And if you're serious about leveling up your investing and trading game, I'd love to have you join our channel membership. It's where I share deeper analysis, earlier setups, and give timely reply to your queries. It is built specifically for traders who want to go further than the free content allows. Stick to your stop losses, respect the volatility, and always trade the data, not the emotion. I'll see you in the next one.